What's up, Squares? Harold Perkins here with this week's edition of Mortgage Questions of the Week. This is where we take the best mortgage questions that we've received during the past week and answer them here for you. Best question wins Question of the Week. If you have questions that I haven't covered yet, please put them in the comments below or message me on any of my socials. The goal is to save you money by preparing you for what really happens in a mortgage transaction. Let's go. Question 1 is from Belinda. She asks, who should I start the mortgage process with? I already live in the house and will be getting a gift of equity. I heard Rocket Mortgage will do this, but I would like more options. Wait, what? I'm gonna let that rocket part go. First, let's start with the gift of equity part. This is awesome. One of the coolest ways to structure a loan between family members is a gift of equity. The way it works is that if you're buying a house from a family member and they're gonna sell you the house at a price that's below market, then you as the buyer can use the difference between that sales price and the actual appraised value as your down payment. Many times you can do the gift of equity transaction without any money out of pocket at all, but it's treated like you put 5 or 10 or 20% down, whatever the difference is between the sales price and the actual appraised value. This is great because not only do you not have to have any money out of pocket to close, it might also mean that you don't have to pay PMI or you get a better interest rate because of all of the equity in the property. Of course, this only works if you have a family member that's selling you a house at a price that's below market. But we see this a lot with maybe a parent that's helping a kid to get a head start on a house and the kid was renting the house from them anyway, and they want to keep it all in the family. But Belinda, to answer your main question, all you have to do is watch my video on how to pick your mortgage broker. After you watch that video, I'm positive that there will be certain mortgage companies that will be eliminated from your consideration. Next question is from Julia. She writes, we're trying to refinance our mortgage that our parents had co-signed when we bought the house, but now the parents have an IRS tax lien. Also, my husband has been a 1099 employee for the last 2 years part-time. He also has a full-time W-2 job that is salaried since April, but we've been told that we cannot use both sources of income and do not qualify. Julia, unfortunately, you have a couple of challenges here, so let's deal with the parents' tax lien first. You have a couple of options depending on the amount of the tax lien. Since your goal in the refinance is to take cash out of the equity of your house, it's possible that you might have enough equity in the house to take out the additional cash needed to pay off the tax lien in full. But if the tax lien is too much to pay off in the refinance, then your parents will have to establish a payment plan that's acceptable to the IRS. And whatever that payment is will be considered in your qualifying for the refinance. So the reason this happens is that once somebody has a lien attached to their name, it automatically attaches to any real estate that that person owns, even though they were just a co-signer, and chances are that your parents' names are on the title to the house. Mortgage companies will not allow a tax lien to slide because technically they can foreclose on your house in order to collect the past due taxes. Now that's an extreme situation, but it's possible, and if it happened, then the mortgage company loses their money. So if you're refinancing with an FHA loan, your parents will need to have made 3 payments on an IRS-approved payment plan in order to close on your refinance. If it's a conventional loan, they just need to have made 1 payment. The second part of your question was about second jobs. So the guideline here is that you have to have a 2-year history of working a second job in order for the income from that second job to count towards your qualifying. The idea here is that 2 years is considered the right amount of time to determine whether or not someone is going to keep their second job and whether or not that income will be stable. This is to prevent somebody from getting a second job in order to show more income for qualifying, but then quitting that job after they close on the house because working 2 jobs is hard. But if you quit that second job, you might not be able to afford the house payment anymore. Obviously, no one would ever do that on purpose. So Julia, it sounds like your husband hasn't had 2 jobs at the same time uninterrupted for 2 years. If that's the case, then unfortunately, no, you cannot use the income from both jobs for qualifying. But it doesn't have to be the same 2 jobs for 2 years. You don't have to have the same employer for 2 years straight. You just have to have 2 jobs at the same time for 2 years. 2 awesome questions so far. If this information helps you, or if you know someone who's had similar issues with their mortgage application, then please make sure to hit the like button so we can help more people. Thank you, I really appreciate that. And now, the question of the week. This is the most trendy mortgage question I've seen in a long time. It's all over social media, real estate forums, and mortgage forums right now. The question is, what the heck is a 2-1 buy down? The short answer is that a seller-paid 2-1 buy-down is a financial mistake. If you are buying a house, don't do it. So the way a 2-1 buy-down works is that the first year of your mortgage, you get to make a payment as if it were 2% lower than what your actual interest rate is. That's the two part of a 2-1 buy-down. And then the second year, you get to make the payment as if the interest rate were 1% lower than what your actual interest rate. And of course, that's the one part. So 2% lower for the first year, 1% lower for the second year, and then you're back to your regular payment after that. But the interest rate is not actually lower, just the payment that you're making is lower, and the bank still wants all of their interest from your actual interest rate, and that's where the seller paid part comes in. So from an amortization schedule, we know how much total interest you would have paid during the first 2 years of your loan. Then we subtract the amount of interest that you will actually pay because of the reduced payment schedule. The difference between the two is the amount of money that the seller will need to contribute at the closing in order to pay for your temporary buy-down. All this is just prepaying interest up front so you can have a lower monthly payment during the first 2 years of your loan. But here's the thing, after the second year, you're back to the regular payment for the rest of the life of the loan. So all of that sounds great, and it does give you a lower monthly payment for the first 2 years of your loan, but here's why it's a horrible use of the money. Here's a house in Phoenix that's listed on the market for sale at the time of recording. The list price is $769,000 and the seller is offering $15,000 to be used towards a 2-1 buy-down. Let's assume the buyer will want to put a 20% down payment and finance $615,200 at 5.5% interest. That payment would be $34.93 per month, but for the first year they get to make a payment as if their rate is 3.5%, which would be $27.62 per month. Then the second year they make a payment as if it were 4.5%, which would be $31.17 per month. Over the course of 2 years, they saved about $13,000 from having a lower payment, and the seller paid for that. Well, that's great, but here's how I would spend the seller's money if I had it available to me. I would do a permanent buy down with the same amount of money. At the time I'm recording this, it would cost $13,571 to permanently buy the rate down to 4.5%. So instead of having the $31.17 payment for just 1 year and then it goes up after, I have the $31.17 payment forever, for the entire life of the loan. So for the same cost, a 2-1 temporary buy down saves you $13,000. But a permanent buy down saves you $135,000 over the life of the loan. So imagine somebody walks up to you and says, I have 2 envelopes with free money in them. This one has $13,000 in it. This one has $135,000 in it. Which one do you pick? You would not pick the $13,000 envelope. We need to stop with the 2-1 buy downs. Now, I'm not roasting real estate agents for finding different ways to market their properties. I think it's great to find a way to make your property stand out ahead of the other one. But what if you advertised a permanent reduction in the buyer's monthly payment rather than just a temporary reduction? I think that would make you stand out even more. This week's questions were great, and you can ask your questions in the comments below or message me on any of my social media. You can also watch any of my other Q&A videos right here too. Later, nerds.